Hey team, this is the weekly overview. It's Boom Traders and I'm TinTinTrading. It's week 31 of 7th of August 2022. So let's jump right into it. So the session overview, we're going to look over two models. Then we're going to look at all the current market conditions over the last week. We're going to give you our interpretation out of it. And we're going to finish with a summary. This shouldn't take more than 20 minutes. So the risk vest model, this is the model that gives an indication about the general health of the market, is currently on sell signal since November last year. We are getting this buy caution, which is an intermediary signal that says we might be getting a buy signal soon since 24th of June. And if we look at the four components that make up this model, we have the general market, which is actually moving quite well last week. We're seeing good prints on the up-down volume. We're going to dig into this deeper further into the video. However, the new highs and new lows are still negative. Stock participation is neutral, and we're going to be talking a bit more about that by the end of the video. Now, the other model that we use solely assesses the market action by how well breakouts are working. Since our main methodology in Boom Traders is breakout trading, we want to see what we're doing in terms of the buys that we're getting and how well are they following through. So far, we assess this as very hard penny environment, meaning, yeah, we are getting a few stocks that are setting up. We are getting breakouts, but they've been very much a pop and drop thing. So that means we are advising maximum caution. Of course, we are actively trading at the moment. This, as we have said previously into the videos and into the Discord room, is only on the heels of success, meaning that only when your methodology on the way you handle the breakouts are working well, then we advise you continue trading. If not, cut down size and outright just even go into cash like we did earlier this year. Now, the two events that happened last week, we did get unemployment rate that went down and covered up all the jobs that were lost by COVID, which was encouraging for the economy, but the market, of course, reacted negatively because this would give pressure into the inflation readings. And then the second thing is that we did get this statement from the Fed that they could use an unusually large increase of the Fed fund rates, but it will all be data dependent. It seems like we were getting more bullish comments from the Fed, and so far things are moving into what the data is showing and how well is the market digestion. Of course, there's a big problem here for the Fed has been the high inflation, and they're battling this with quantitative tightening. At the same time, we are seeing fiscal policy actually not backing down that much. So maybe this is the way that we are gonna achieve the soft landing that we were promised by the beginning of the year. Now, if we look at the general market, we have the Nasdaq Composite. So since we got this follow through day down here, we've been actually getting a really good confirmation versus violation signals. So far, the count is 4 to 8, which is quite promising. We are seeing these moves up here on higher volume. However, caution is advised given that we're now starting to stall here. As you see, the closes are right at the same level and we are not seeing much of a higher volume, which in the past has indicated that basically institutions are not really digging into this rally. My general guess is that we might be going and attacking the 200-day, and from then on, if we get somewhere close to it, like up here, probably institutions will use that to sell into that rally. Just my personal opinion. At the same time, the SPX is showing a bit more encouraging action since the violations here are only 3 from the market model that we use in order to assess how we're bottoming. Again, as you see, a lot of green, mostly green, not so much distribution. This is very much contrasting the rallies that were happening here, as you remember, and here when we were getting this action up, but then at the same time, we did get quite a lot of vision days right after the follow through day. So here, for instance, here, and so on. So this is encouraging for sure. Given that we trade stocks, we are being very cautious at the same time. If we look at the down versus up volume and the up versus down volume, basically back in June 14, we did get this exhaustion volume downside, which was very high. Actually, this was a good sign because that's how usually markets bottom. And afterwards, we've been getting this also very encouraging action with multiple follow-on days of versus down volume with more than 10 to 1. However, as I said, it is a bit worrying that we're not pushing up on above average volume so far. Sentiment, we are still bearish, which is bullish, because this means that the market hasn't gone outright bullish given this rally. Of course, this might be the actual reason that we might see a selling into the 150 or 200-day moving average, but so far there's still quite a lot of bearishness out there. If we look at previous periods when we've been getting similar price action. This is a study from Ned Davis, which shows that every time that there's a quarter with over 15% decline, there seems to be a tendency for the S&P 500 to actually rebound. And here, as you see, I've shown this picture before. After World War I, we see that pretty much most of the quarters, apart from the next quarter in 2008, have actually been showing positive results. So this is very encouraging. This is from quarter first quarter afterwards to next 8 quarters. So we will be seeing what's gonna happen. But as I said before, inflation is the main driver here, and what happens to inflation is likely gonna dictate the market. And when we talk about inflation, basically, we look at our general reading, we look at the copper, lumber, oil, wheat prices, we look at the energy sector, we also look at the used cars and inventories. And so far, things are actually pointing into the right direction. Prices of the main commodities are going down. As you see, they're so far here under the 150 moving average on the daily time frame. Inventories are packing up since the last few months, and actually used car sales are going down. So all of these are pointing that the general market is getting a good chance, given the fact that inflation has actually eased off of pressure. However, if we look at other periods when we've been in similar situation, there's actually two places historically where we could be. And I'm just going to show you the Dow in 1970s. We could be here. We could be just having a pulse on the way down, or we could be just carving out a bottom down here. We don't know where we are yet. Of course, this we can only be certain after the fact that we've seen the price action. But the function of this is basically dependent on if we're gonna get a soft landing or not. You've seen the previous studies that we've shown on fast tightening and slow tightening cycles. Basically, it's really gonna be dictated whether or how we're gonna get a recession, and if this recession is gonna be mild technical recession or it's gonna be prolonged longer recession, which in the latter case is likely gonna push the markets much further down. Now, that being said, when we talk about recessions and bear markets, we're gonna post out a study soon, which is gonna be called Lessons from Studying All the Bear Markets since 1968 and 2022. We did find some interesting similarities between the different bear markets. That's gonna be posted on the TinTinTrading Substack newsletter. Go in and check it out. I think this is coming in this week. You'll be able to download this data. And of course, we actually have a bunch of data points which we haven't included in this newsletter, but we would love to talk to you about on the Substack. And if you have any questions, we will love to answer them. So the causation is inflation drives the Fed action, and the Fed action drives the stock market. You've heard us say this before. So it's really important to see how this is going to play out. As we stand on our previous overview of the historical studies that we've been doing, and so far we are still keeping our idea that we are somewhere similar to the 1990 situation or the 1962. And I've just taken a picture from previous videos to show you what these look like. So the 1962, we had a 25% decline. From then on, we carved the bottom. So we were getting this kind of tradable rally, but then we retested the low. So this might very well happen here. We will see. And here is the 1990 scenario. As you see, again, tradable rallies up, but moving to the sideways. And what's interesting here is that if you look at the 1990s and how we've bottomed, that's actually part of the study. Also, we have it in the Substack newsletter. You'll see that the leaders actually did bottom and pull back to the breakout levels before we got this actual rally up, which made them actually very easily tradable. Of course, shakeouts might occur, and currently our breakouts that we've been trading, we've been seeing a few names. I mentioned those on the trading chat in the Discord server, but we've been seeing a few names whereby shakeouts have occurred. Side note, if you want to learn more about pulling back to the breakout levels, we also included in the Substack a study. We call this pullback a throwback, because technically the pullback term is on the other side, on the bearish side. But go and check that out, and you can see what are the chances that the breakout might create a pullback or a throwback. From then on, if we look at the Nasdaq Composite again, but also look at the percentage of stocks which are above their 50 and 200-day moving averages, we are also getting encouraging moves up, with the 50 moving averages up to the 67% of the stocks in the Nasdaq Composite are actually currently over the 50-day moving average, which is quite good. The other important positive news is that on our model for volatility versus price action, we have moved from super bearish volatile to now crossing over to neutral reading. So the price action is neutral and the volatility is getting quite neutral. Of course, we were here about 10 days ago to a similar situation. So it's important to see if this is going to push us and we're going to see pushes to the left and we're going to see more bullish action, or if we're going to go straight back into the super bearish volatile quadrant. So that being said, models are still on caution. Market is moving up and it's making good moves up. Sentiment is bearish, which is good, and stocks that we are seeing are setting up. However, the big problem is that breakouts are not working, and henceforth we are seeing that a situation whereby markets are moving up, yet breakouts are not working great, and this can be a very frustrating time for the newer traders out there, since you'll be seeing that the indexes are moving up and so on, but maybe your individual trading is not doing great. However, for those who are veterans, that will tell you this is completely normal. And basically, just follow price action, follow your individual stocks and how they're doing, and make sure that you allow the market to drive you in and out of exposure. We do not advise having more than 25, maximum 50% exposure currently in the market, and this is only if things are working well. But just do yourself a favor and don't be misled by the indexes. Be prepared for the occurring of the lows. Currently, we're at this junction whereby we are either going to see a continued tradable rally, but we're in a situation where a pullback is very likely to occur. So just tighten up stops, lighten up into positions, and make sure you are cautious. What we want to see, and this is what we want to see now, because as you see, everything else seems to be falling into place, is that we've been seeing stocks in bases, we've been seeing stocks breaking out of bases, but the big problem is that none of this action is actually following through. We're seeing pop and drops. LNTH is a recent example, but a few others were mentioned in the Discord room. So we're wanting to see that after this breakout, that institutions are really getting aggressive and moving back into positions. So far, we're not seeing this, suggesting that it's more of a weaker hands which are moving the stocks. And if I move back to analogy that we spoke about some time ago, this is very much the egg action. We see pop, and then when they drop, we don't bounce, rather than what we would call the tennis ball action. So we are on the watch out for that, and that's what's driving our exposure. Also, we mentioned that in the Discord server, but the long-term trend model has been moved to buy signal. Our suggestion here, and this is only for investing into the SPX, not in individual funds, because of course mutual funds have different strategies and so on, and 80% of them actually underperform the SPX. But our suggestion is that you might lighten up and go into 25 up to 50% exposure here, as things are looking well for that point of view. So hope you enjoyed this. I'll see you in the Discord and have a great rest of the week.